This is Jacob. How may I help you? Why, hello there, gorgeous. How are you? So get yourself set up. I'm going to do the same thing. Like this has got to be over here, so it's pretty. I don't know why it was moved. That was not me. I blame the children. Everything looks so funny now. Why does it look so funny? Where are my orchid blooms? Oh, I'm going to kick those kids in the teeth. Brand new orchids, and they're just doing this shit. Stop moving my stuff. Whatever. Close enough for government work. I had this down. It was standing up. Kind of. That looks okay. Well, what the hell? This is the thing about having kids. You never know what's going to happen. Like, period. Let me pause this. Why, hello, Kasia, my dear. How are you?
Hello, Jacob. Doing great. How are you?
Oh, I'm great. I'm so glad to see you. I always love seeing your smiling face. What's the weather like in Chicago right now?
It's cloudy, humid, hot, rainy. It's pretty bad. It's pretty miserable. How about you?
What's the temperature? Well, it's like it is usually here in Florida. It's sunny, upper 80s.
Yeah.
Go to the beach, go to the movies. Go to the movies. Can't really do much of anything because we're in the pandemic lockdown. So it's been a bit inconvenient.
Mm-hmm.
But I can go for a walk without worrying so much. I like your shirt. That's very fun. Pop a color. So you had a vacation last week.
I was in Seattle for a wedding and just got back last night. So I haven't traveled in a while, but everything was really smooth. And I was surprised on just how smooth and I don't know, like people were just calm and they kept their distance. So it was good. It was a good travel experience.
It was civil.
Yes.
COVID.
Which is kind of, crazy to find at an airport, an airplane. But everyone did a good job.
Were there stores open yet? Because like when I traveled a couple months ago, it wasn't open yet.
So it was weird. I mean, the Midway Airport, all the restaurants were all like almost all of them were closed. The airport in Seattle, all the restaurants and shops were open. It kind of depends. I mean, a lot of things were open and a lot of things were closed, to my surprise. It was, it's strange. It's strange to know what to expect. So
you never know what to expect because every time you think you're going somewhere, something else is different. Like I don't quite know how else to put it, but it's constantly changing. So I don't know what to expect.
Right.
But
right.
Part of the thing, expect unexpected and you won't be disappointed. So perfect. Okay, so for those of you who are watching on Facebook, I just posted the link if you want to click in and join in our discussion. Kasia Macioch is here. Macioch. She's here to actually, with the Chicago IRA Club, she's here to teach us about the changes that have happened with your retirement accounts now that COVID has taken over the world. For those of you who don't know, the government's been printing a lot of money and giving stimulus checks to the citizens of the United States to try to keep our country going economically and keep things moving. And one of the things that they did, which most people aren't as aware of, are the releases and benefits when it came to accessing retirement funds and what we can do with them exactly. So I wanted Kasia to come on here to talk about what some of those changes are, how you can use them for real estate, and how you can use them for stock. So Kasia, thank you for joining us today.
Sure. Thanks for having me. So a couple of things before we dive deep is I just want to put a little disclaimer out there that companies like IRA Club and administrators have not received a lot of information about this. So they're kind of, as we go with the flow and like we were just saying, everything is changing and everything is different. It's a little bit difficult for companies like IRA Club and other self-directed IRA administrators because we don't have all the answers, but we'll keep it really high level. And when it comes time for you to, take funds out or take out a loan and then have to pay taxes, you'll just work with your CPA to help you figure that out. But we can talk about the pros and cons of the CARES Act. But just be aware that not all of the information has been released yet. I think, the government is just trying to figure things out. But a lot of folks can maybe kind of think back to Katrina and similar, acts were also passed back then. So, just again, we don't know all the information and things do change a little bit, but again, we can talk about the pros and cons. So essentially the CARES Act was released in March. And what the CARES Act allows you to do is two things. You can, number one, take out a loan from your current 401k. A lot of folks do this. Typically the maximum amount that you can take out is $50,000. But again, with the CARES Act, this has been increased to $100,000. And you would just simply work with your HR department or your 401k custodian and let them know that you would like to, take out this loan. Since I represent IRAs, we can talk more about IRAs and the benefits of, and I guess maybe not the benefits, but the opportunities of the CARES Act and IRAs. And the CARES Act will allow you to take out a distribution out of your IRA, whether it's a Roth or a traditional, up to $100,000. So again, whether it's the 401k or the IRA, if you have one of those, you're able to take out some funds. So, real quick, before you get too excited, you just want to make sure that you or your spouse have been affected by the coronavirus. So such things as you or your spouse actually, being sick, testing positive. Wages, your wages are suffering, your hours have been cut back, you've been furloughed. And then lastly, kind of to go off of that is childcare. Childcare was not available. So maybe you had to, stay home and help take care of the kiddos. So, I think almost everyone has been affected. I mean, I don't know, I know a handful of people that have not been affected, that have been working full time, but majority of folks, I think, have found that they have been affected financially by this, by this virus. So again, in order to be able to take out that loan or take out that distribution, you must have been, affected by the coronavirus. So again, those are the stipulations. The pros of this is you are able to take funds out. Again, maybe they are in your 401k or the IRA, and you need those funds, whether it is to pay rent or to pay medical bills, or to invest. Again, those funds are available to you. They are your funds. It's your money, your hard-earned money. So you're able to take these funds out, and you will have to pay the taxes on these funds. So if you have a traditional IRA, you will pay taxes, but those taxes are divided within 3 years. So you're not paying that, that large sum up front, but you are going to take 3 years to pay the taxes.
Is there a percentage that is like what's a quick calculation to explain?
I mean, yeah. So if you're, for example, if you're taking out if you take out $9,000, then it's just you would, or if you owe, let's say you owe $10,000 in tax, right? Because maybe you took out, I'm trying to think real quick. I can't do math right now if I don't write it down. But if you, if you take out, maybe, let's say you take out the full 100K. So you either take out a loan or you take out the distribution, and you are taking out all of the 100K. And let's say you're in the 20%, tax bracket, just again for easy math. So you will owe $20,000 in taxes divided by, 3 years. So about, 6K. Yeah. So again, it's you're not paying that big penalty up front, not penalty, but not paying taxes up front. It's divided within 3 years. So the other important thing to mention about this is there is no 10% penalty if you are under the age of 59 and a half. So typically, if you take out a distribution, it's called an early distribution, you have to pay a 10% penalty to the IRS. So again, with Corona and with the CARES Act, the IRS has taken that away. So you're able to take out the funds without paying that 10% penalty. Again, they are just trying to, to help us. And have these funds be available to us. So those are the benefits that, you will pay taxes if you have a traditional, if you have a 401k, but there is no 10% penalty. One thing to keep in mind is we'll kind of talk about maybe some of the strategies and different things you can do with this, but just keep in mind, if you are going to take the funds out, it's really difficult to put funds into a retirement account. We're limited to contributions and 401k maximum contributions. So before you do take out the funds, just keep in mind that it took me this many years to put funds into the account. It'd be wonderful if maybe you can use it for the time being, but hopefully in 2 or 3 years, you're able to put some of it back. So, just making sure you're thinking of it in different areas, different venues.
So I've had a couple of people ask about how this has affected their TSP or their government retirement plan. If you don't know what that is, it's a retirement plan that is given to our military and veterans. So it's like a pension fund for the government. Do you know if they can pull money from their TSP and if they're able to roll it over into a self-directed IRA because of the CARES Act?
Yes. So that's a great point. So we've had a couple clients that have done this, whether it's a 401k or TSP, and they have taken the funds out where typically they were not able to, and then transferred into an IRA. And so there is, no taxes to pay because you're just doing a rollover. But again, with the CARES Act, this has kind of opened up a lot of doors for different clients. And again, typically you're not able to move funds if you are currently employed. But again, with the CARES Act, this has allowed clients to move over funds and start investing by using their self-directed IRA.
Okay. So it's usually, for those of you who don't understand what that means, it's very hard for people who are in the services to have access to their funds, really. I mean, there are certain vehicles that they can do, like take loans and stuff against it, but they're more regulated because it's government money, I suppose, or just
for sure.
So yeah, so now that they have the access to these funds, because they have, a lot of these individuals, if you've been in the military for, 10, 15, 20 years, you can actually accrue quite a bit in your TSP. So now you have access to those funds. So if you want to get a higher return than what you are getting through your TSP, now you have access to those funds and you can roll it over into a self-directed IRA and have more control on what you're doing with it. So Kasia, say we have a veteran or a serviceman or woman and they wanted to do just that. They can take out $100,000 max from their TSP. I'm assuming that's the same limit. Am I correct?
Yes, exactly. 100K would be the maximum.
They're able to access $100,000 from their TSP. They can roll it over into a self-directed IRA or a self-directed Roth IRA.
Yes.
Taxes. Okay.
So yes, it would go into the traditional first, and we can always do a conversion. But yeah, so essentially you would go to the TSP website. There's a form you'll fill out. You'll just, let them know the funds and where they're going to go. Those funds will then transfer to the IRA Club, and then there you'll be able to do alternative investing, again, as Jacob mentioned, with potentially higher returns than what you have been getting. So
they would be able to do that. So what is the average rate of return for, like, say, a TSP? Do you know?
The TSP, it's actually one of the better ones, which is good. I don't know offhand. My coworker, he knows all the numbers, but and I don't want to say the wrong number, but I mean, I would probably say maybe 6 to 8%, like maximum. But the TSP compared to some of the other plans is one of the better ones, but still probably not double digits.
Okay, I did not realize that, but that helps, because on average, your average account through that the stock market has performed with over the years, it averages about 8%. Okay, that's your average return. So that's why, if you're able, but again, it's volatile. No one knows what it's going to be, so on and so forth. And that's, if you have someone else just handle your money, like your financial planner, maybe that's fine. Maybe that's golden. Good enough for you, no problem. The more money you have, the slower it grows because of the volume you have. So if you have like $5 million and it's growing at 5%, well, those jumps are substantial still, even though it's 5%. But if you only have $50,000, you can actually get quite a bit. Oh, here's what I wanted to get in here. You can actually get quite a bit if you're doing like 10 or 15%. And that's something that you can do through doing even lending through your retirement account, right? So
Sure.
I'll use an example of what I've done with my investors, which is how I built credibility when I was getting started with my investing, because most agents, brokers, and investors don't know you can do these things. But Kasia, why don't you tell us about what you can hold? Like, part of this is I want to talk about what notes are, like how you
Mm-hmm.
hold notes in your retirement
Mm-hmm.
account.
Mm-hmm.
So you lend against your retirement account, how you
Mm-hmm.
trade stocks, and how you hold real
Sure.
estate assets. Can you touch a little bit on that for me?
Sure, right. So I mean, those are just a handful of different investments that your IRA can hold with, IRA Club, a self-directed IRA company. So again, it's up to you. It's up to the investor to find that investment and invest in what they're passionate about. But real quick, real estate is our number one most popular investment, and that could be anything from single family homes that are receiving rent checks, commercial property, multifamily unit property, vacant land, flips. So again, the list goes on, but your IRA can essentially hold this hard asset, and your IRA would be receiving the monthly, rent checks every month, income tax free. So, instead of purchasing Disney stock or Amazon stock, your IRA is purchasing a house on 123 Green Street. So again, that is our number one investment type. And then lending, as Jacob mentioned, is also a great tool. Your IRA becomes the bank. And so what happens is your IRA will lend money out to another person. That person cannot be you or your spouse or your children, or your company. There's no self-dealing, but anyone else, you can lend that money out of your IRA to that borrower. And what's great is, since your IRA is the bank, you would draft up the contract, the promissory note, and in there you would mention, the interest rate, if you're going to charge any sort of, points, how often this person is going to start paying you back, if it's a balloon note. So all of that is in your control, and you would draft up that contract. And again, it's between you and the borrower. It's all about that relationship that you've created. And then your IRA would then lend that person the funds, and that person, the borrower, would pay back your IRA, again, every month, every quarter, depending on what you've established. But again, all income tax free. It's all going back into your IRA. And then you can just keep doing that and doing that. So again, a lot of these loans are short term, which, is great because it creates a sense of urgency for the borrower to start paying back your IRA. And again, then they could be as small as $2,000 or $5,000. So it's letting these smaller accounts grow at 10, 12%. And then you just do one loan and then do the next, and then kind of keep going. And it's a snowball effect. And you can have multiple loans out at once. So the lending is, again, really, really powerful. It's great because it's a, kind of a shorter term investment. And then, similar to lending and real estate would be to hold notes. So your IRA can essentially, purchase, something like a mobile home note, and your IRA would then receive the, again, maybe the down payment and plus the monthly income. You could do seller financing. You could purchase mobile homes that are on lots or that are on land. So again, a lot of opportunity, a lot of, great kind of out of the box investing.
I'm glad you mentioned that, because that was like the perfect segue while I was setting this up. Yay! So let's talk about what she's saying here. So again, when you are, there's so many cool different strategies that you can do with with real estate, with investing. Really, if you look at investing as an art, there's really no limit to what you can do. It's really cool, and you don't need a lot to start. In fact, I started with nothing. Okay, I had to get a lot of knowledge, and I had to build my credibility, and that took a lot of work. So I'm trying to shorten, for those of you who are just getting started with your investing career, I want to shorten your learning curve by providing that credibility to you, which is why you have people like Kasia of the IRA Club and some of our other partners coming on. So now you can say, okay, listen, this is who I'm working with. This is what they say. You don't have to pretend to be the experts. You just happen to know the experts, and you are that database that they can go to. You're the Google for their investment funds. So let's go ahead and talk about what she's talking about here. Then I'll only forget to tell you about the gold. I'll only forget to talk about the gold. So let's just say she was talking about mobile homes. So I went ahead and drew one. You can tell I was a dancer and a singer. I was not an artist. Okay, this is my own self-portrait. I was very skinny at this point in time. I was dancing a lot and had Tic Tacs without the coating, and cigarettes and coffee. It was a great diet. Anyway, slim, gorgeous. Moving on. So let's talk about how this is how I actually do deals. I've got a couple of my investors on this call, and they've done this with me, so they can actually validate what we've done. So I'm not making this up. Kasia knows I work with her. Jessica, Josh, Jim, I don't know if he's on, Megan, they all know that this is legit. So if you've got questions, ask them. So this is what we do. So say there's a mobile home I wanted to get into, okay? Now, it takes time to flip anything, to remodel anything. But the thing about mobile homes, which is great, is if you don't have a lot of money in your retirement account, you can grow that vault quickly through asset classes like mobile homes or flipping cars or what you talked about, the Super Bowl tickets last time. Brilliant move. Brilliant move. Don't forget to talk about that. That was great. So no matter what investing you're doing, you want to buy right. You want to buy low, sell high. Basic, everyone's heard it, still stands the test of time. That's what you do. The only time you don't do that is when the loss of an investment is actually going to keep more money in your pocket because you can write it off against your income for taxes. If you understood that, then you need to be on a different call because that's definitely more high level. But for those of you who don't understand it, that's fine. That means you're not there. Okay, so what this is, so say we have this mobile home right now. The mobile home averages around the country about $7,000. Okay, some places are less, some places more. We just put one under contract for $500, and yes, I'm in Southeast Florida. Okay, it's going to take a lot of work to repair, which is going to be the equivalent of $2,500. Yes, for the entire mobile home. Now, please understand what I'm about to show you is just a cash flow strategy. Cash flow is king. This is just a cash flow strategy that's designed to help you bring money in and then leverage up into different asset classes and buy shares of syndications, which you can also do through your IRA, things like that. I'll have Akash talk about it in a second. But just so you have an idea of what this looks like. So say we have a mobile home, okay? We have this mobile home and it's going to be $7,000. Okay, so we have a mobile home that's $7,000 for us to buy into it, okay? Now for easy numbers, we're gonna go ahead and put in $3,000 worth of repair. So automatically I'm in this for how much? $10,000. Dancer brain, I don't count that high, I keep it easy numbers, okay? Be patient with me. So I'm into this for $10,000. I need $10,000 to do this deal. But I am a new investor and I have no money. Okay? What am I gonna do? Well, I'm gonna make a friend. And my friend is going to be named, who's on this call? I'm gonna make Bo my friend, because I just saw he's on this call. Perfect. Hi, Bo. How are you, my friend? So now, oh, Fred's coming in. Fred Dumar. Oh, I love this man. I'm going to hit on him in a second. He's having more babies, but we're going to do it in a second. So Bo is now going to be my friend. So this is me, so it means Bo's going to be roughly this tall. And he's going to be pink. Yeah, so he's slightly shorter, right? Bo has no idea about investing. But he knows that he likes me. And he knows that I know what I'm doing. So I'm now going, okay, slight smile. Good times. So now, Bo wants to make money on his money. He has a retirement account that he's now converted over to a self-directed IRA. And this is what we call a vault. All right? So this is my vault. It's like one of those crank handles. I told you I wasn't an artist. Go with me. What if I make it three-dimensional? Okay, so this is a self-directed IRA that's holding his money. Okay, just shut up. I don't do this often. I'm working on it. So this is a self-directed IRA that he has opened up with Kasia. Kasia, you're always gorgeous. I'm not going to try to make you look worse than that. Okay, I'm sorry. So he has how much money in his self-directed IRA? Bo, are you here? Can you unmute yourself?
Yeah, I'm here.
How much money would you say in your example, and it is thank you very much, my friend. How much do you say you would have in a self-directed IRA in this example? Just give me a number. It has to be more than 10.
Let's go for 10,000.
You want me to? Let's go 10,500 because you have to have $500 that you keep in the account. So is that okay? All right. Yeah. So he's got $10,500 in this account. All right. Now, what Bo's going to do is he's going to make a note with me. That actually looks like paper. Okay. And on this is an IOU. That's what a note is. Okay. It says how much we're going to do on it. So Kasia, in your promissory notes, what are on the promissory notes that people actually have to sign?
So the name of the lender, which would be the name of the IRA. So it would be IRA Club, FBO, Bo Smith, IRA account number 12345. So that is the lender. Again, it's not Bo himself because Bo doesn't want to pay taxes on it, or Bo wants to utilize his retirement funds. So again, it would be the name of the lender, which is Bo, the name of the borrower. So again, this could be an individual or an LLC. And essentially then kind of what we talked about earlier, the terms, how much is Bo's IRA lending, the interest rate, how often will the borrower be paying back? Again, all of that again is based on your relationship. So that will be drafted up in the promissory note.
And it sounds crazy, except I have done a few of these now, and they're surprisingly simple. Like this one page, you fill it out. Actually, when you do it through now it's DocuSign, it's like what, 3 pages?
Yeah.
Not very long.
It's a couple pages, right?
And like one of the pages is just telling you how to fill it out. Like it's
right.
It's not hard at all. Click, 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 done. It takes me all like maybe 7 minutes to do one of these now. The first one took me like 20, but now I can copy paste, good to go. So it has the lender's name, the IRA name. So this would be Bo's IRA. It would have the borrower, which in this case is me. They would have the amount that we're borrowing, which in this case would be 10,000. Okay, and then we're gonna have the interest rate and then the points. Bo, how much money do you want in your money? Give me an interest rate. How much will you charge me to use your funds?
I don't know.
It has to be at least 1 over prime. So, it could be 8%, 10%, 15%, 12%. What it's again, you're in control, Bo. So whatever.
Let's go 12.
Whatever you want. Okay.
12%. Okay. 12%. Now remember, 12% is only 1% a month, right? I love that. So we're going to be doing 12% on his money, which for most people sounds high, but when you're investing, remember that's annualized, annual percentage rate. So if you were to take that number and divide it by 12, that means for every month I'm going to borrow his money, Bo's making 1% on his money. We're not going to do points right now because I don't want to take up that much time. But that's the idea. We have the name, we have the interest amount, and now Bo's like, okay, cool. So he's going to wire that money to me, and I now have to pay $10,000 plus 12% over the course of, sorry, the phone's tripping me up, over the course of a year, right? Now we're gonna have a lot of stuff started and saying what it's gonna be, but let's say this is interest only, so 10,000 times 12% equals 1,200 divided by 12, which means that's paying $100 a month. Ooh. So he's getting $100 a month just from letting me borrow his money, okay? So that's $100 a month. Now I'm in this mobile home for $10,000 of Bo's money. Thanks, Bo. I'm in the deal. Are you happy because you're making 12% on your IRA versus the average of 8% of the stock market?
Yeah.
No.
Good. Dude, Jesus, make me wait for this. You're interacting here, okay? So
I'm
now,
sorry, I'm doing like 4 things at once right now.
so glad. So now he's making $100 a month on his payment, no problem. I've got $10,000 here. I'm going to put in this mobile home, and let's say because they're small, they're quick, right? Single wide, double wide doesn't matter. They're a damn car that people live in. So I can do this, and I'm going to calculate my holding costs for 2 months because they're fast, right? So let's just say I'm in this, and I have 2 months carrying cost, and then I have, so that's going to be a total of, with his doing here, $100 that I've got to pay him, right? So he's going to have $200 there, plus I got lot, rent, electricity, blah, 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 but we're going to cover that later. Now, I'm going to sell this note on seller financing. So say I actually just say, okay, Bo, well, I'm going to get there in a minute. I'm going to sell this mobile home on seller financing. And what that means is I'm going to hold the note. I'm going to be the bank. Or in this case, I'm going to be the intermediary between the mobile homeowner and Bo's IRA. This is a way to do this. For those of you who understand lease options, this is part of it. One of the ways to sell lease options are a form of seller financing. So from here, I'm actually going to have $200, which I got to pay. Oh my. Now I'm going to sell this property to a homeowner for $20,000. Easy to do, really easy to do. So I sell this for $20,000 to Fred Dumar, who would never pay $20,000 for a mobile home, but he knows where I'm going for it. Right, Fred?
He thumbed up.
He thumbed up?
He thumbed up.
Oh, he thumbed up, thanks. So now I'm going to subtract my purchase price. I'm going to subtract my carrying cost for my note. There are other things here, but this one I'm going to put in here, which means I have $9,800 in profit when I sell it. Now, this is if I seller finance it. If I do this, this is no interest. But what if Fred buys this from me? Let me make Fred. This is mustache. Okay, so now Fred has bought this property for $20,000 from me, and we're going to charge him 15% interest. Why am I charging him 15%? Who can tell?
Get the spread.
Correct. So $20,000.
You don't like me.
Exactly. You're driving me crazy. See, there's a mustache. I was right. Maybe a little bigger if I want it. There you go. Mustache, Fred. So now I'm going to charge him 15% interest. Now, why is that?
Boo.
What?
Boo.
No. Now, I need to pay something back right away. All right. So I'm going to charge them. They're gonna put down a down payment, for example. But I'm just going to keep this simple right now. $20,000 is what they're paying times 15% interest means they're going to pay me $1,000. I did that wrong. 20,000 times 15% equals 3,000. Thank you. So that's going to be $3,000 a year. Oh, how much do I have to pay you a year?
Sorry, what?
How much do I pay you a year?
Good question.
$1,200.
What's 100 times 12?
Oh, I'm sorry. I can't see your whiteboard.
Not my fault. So what's 100 times 12?
1,200.
Very good. Which means I would make how much?
I seriously can't see your board. Sorry. And I'm like,
Anyone can jump in here. This is interactive.
$1,800.
$1,800. So he was making what he specified at 12% on his note every year that he's going to get paid every month. Fred is going to pay me every month $250, which equates to $3,000 a year. After I pay Bo, who's paying Bo's payment, me or Fred?
Fred.
Fred's giving me the money for it, right? And after that $250, I give $100. What's left over for me?
$150.
$150. So that gives me a profit of $1,800. Bo is making his money by being my partner in the deal, by being my lender. I'm making money because of my knowledge and education. I put the work in, I remodeled, I found the property, I found Fred, the buyer. I earned that money. I'm not taking advantage of anybody. I put the work in. I just put his money to use when it wasn't doing much. So now he's making more money, and I am actually making a profit over time with it. So especially if this is a 5-year note, you just do that over and over and over and over and over again, okay? So that's the idea. Now, the other cool thing, which I'm gonna have Kasia talk about, is IRAs can actually partner with each other. Is that correct, Kasia?
Absolutely. Sure. So, in this scenario, Bo's IRA was the lender. But partnering is a very powerful tool that allows you to make these investments happen. So let's say, Bo's IRA only had $5,000 in there. So none of this would be, would have happened if it was just Bo's IRA with 5,000. But let's say Bo has a brother, and his brother has maybe $20,000 in his IRA. So Bo can put in 5 from his IRA, and then his brother can also put in 5 from his IRA, and then this would be a partnership of 50-50. But again, the percentage could be anything. So you can even maybe partner with yourself if you wanted to. So your IRA can put in some funds, and then you can put in some funds, or you could partner with your spouse. It's very common to see family members partner. Again, it's a little bit different from investing in. So Bo isn't lending money to himself. Bo is investing in this promissory note. But again, you can partner with yourself, partner with your spouse, partner with your LLC. And again, partnering allows you to make these investments happen.
When you guys are thinking about partnering with yourself, it's the same thing if like you had a brokerage account, you're buying into a stock, right? That's your money. You're partnering with yourself to buy this share of Apple, for example, because the whole point of IRAs is to use them to invest. That's what retirement funds are designed to do. What we're doing with a self-directed IRA is just what they are designed to do. There's nothing crazy about it. There's nothing illegal about it. In fact, it's actually, I will keep my mouth here. I'll let Fred talk about it, but it's more legal because you're in charge of it, so you have more accountability, right? So no one's gonna care for your money as much as you are, okay? So this was Bo's brother in this example, and then they put together partner, joint venture, and they can go into this deal and have their names on the IRA note, right? So things
Exactly.
like that you can create. And it's really cool to do that. And there's no limit. Well, there might be a limit. There are a certain amount of IRAs that can get into one deal, I remember, but like if you're doing like in a mobile home park, you can have I think 100 members in an LLC that can do it, I think. Am I correct?
I think so. So yeah. So sorry. If you're doing a syndication, if you're investing in into syndication, there could be unlimited, or maybe it's 100, but many people can put their money together towards that syndication. If you are making an investment and you're going to be on title, or you're going to be on the promissory note, we want to keep it around 4 or 5 people, because then every month splitting up those rent checks or paying for maintenance, it gets a little tricky once you have more than 4 accounts. So again, typically we see this very common with husband and wife and their 2 kids, so that is very common to partner with your spouse and your family members. But again, the syndications can be many investors coming together on this large project.
So going back to the simple note before I get into syndication, because I don't want to confuse anybody, but doing something simple about this, because this is something you can do all over the country. It's the fastest growing asset class in the United States. Trust me, it's not sexy, it is not glamorous, but the returns are fantastic. Okay, so if I have one of these properties right here, this is a 5-year note, because I don't hold notes longer than 5 years on mobile homes personally, but that's my model at this time. It will change as I change, right? But 5 years, if he's making $1,200 a year, Derek, how much interest will he make in his retirement account over 5 years?
Over 5 years at 12%.
Mm-hmm.
Yeah, $6,000.
$6,000. On top of he gets his $10,000. So now over 5 years, that's now $16,000 that he has in that account.
Yeah.
Well, $16,500 if we count up there. Now, how much am I making? 18 times 5.
Yeah. So,
9,000.
Yep.
Bo, are you upset that I had to put all that work in and I made $9,000 and you only made 6?
No, I just wish I would have done it all instead.
And you certainly can. I'll hand you the hammer. You can go on the websites and find the individuals, find the mobile homes. You can actually go there and find the tenant buyers, talk to Kasia, set everything up, learn how to actually structure these joint venture agreements, make sure you're staying compliant, do the deal analysis, make sure you know what your interest rates that you can afford are, and then you have to make sure you're dealing with mobile homes and managing the note for the next 5 years. Does that sound like passive income to you or earned income?
Earned.
So you are literally sitting on your assets making this, and I'm busting my assets making that.
Currently, yes.
See? And that's fine. The idea here is as you're starting, just get in the game. And you're going to make more than this because you're going to keep flipping that money over and over and over again. But I want there to be a simple explanation so you guys could see how this works. Follow me?
yeah.
Thank you, Derek. Everybody else? Cool, got it. Now, Kasia, am I missing anything with this example?
No, I don't think so. I mean, again, it's you know, I kind of want to touch base on it. So if you're using your IRA to invest, you are not able to do physical work on that property. So anytime you're using retirement funds, unfortunately, the IRS limits you to only pick up a pen. So you can't pick up a hammer, again, if you're using retirement funds. So you do need someone like Jacob to, you know, do the physical work. But again, as you mentioned, it's passive. You're growing your retirement income tax free. And then all you have to do is sign that promissory note and you know, check your account every couple months to make sure funds are coming in. And that's pretty much it. You're not dealing with the tenant. You're not dealing with, you know, all of that kind of noise. And again, it's just, you know, passive cash flow. It's amazing.
It really is. And it grows and grows and grows. So every month when he's getting his $100, that's going right into his vault. So now that's $10. Now that's going to be worth $10,600, $10,700 every month as it goes in, right? So that was funny. So that's the idea, which I enjoy doing. Now, any asset can do this. And Kasia talked about this really cool thing she had a client do using Super Bowl tickets.
Sure.
Talk
Right.
about
So yeah. So again, so, you know, I kind of mentioned the common investments, real estate, lending, but you know, there are a couple folks that will get very, very creative and use their IRA funds to purchase, for example, you know, some of my favorite examples are would be the mango trees and the Christmas tree farm. So you would use your IRA to purchase these, and then you're literally watching your money grow. And the proceeds from selling the mangoes or the proceeds of selling the Christmas trees during Christmas time would go back into your IRA. We did have a client that purchased Super Bowl tickets with the IRA funds and then sell them for a higher value. And then the proceeds went back into that IRA. So you can get very, very creative with these investments. The couple things that you cannot invest in would be life insurance. So you can't use your funds to purchase, you know, your own life insurance, and then collectibles. So baseball cards, vintage cars, art, wine. It's just a little hard to put a value on those things. But, you know, again, we've seen some really creative investments.
Write all that down. So you can do collectibles, you can do wine, and life insurance, things like that. And this is
that's it.
That's an interesting point, because even though it's hard to put a value on them, that's because these are other vaults. These are other places you can grow your wealth, right? So life insurance policies have what are called like death benefits, and have different policies that go with them. So you can actually, you've got your death benefits and you have your policy. I'm not using the right words right now. Your cash benefit, thank you. So you got your death and your cash benefit. Well, some of the things I've learned through my nonprofit, by the way, but you can actually take loans against your cash benefit and keep your death benefit intact. So if you're growing your wealth in life insurance, guess what? That's going up, 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 up. Collectibles go up in value. That's why you can't actually think of them as, you can't double dip them, right? Because this one you're literally growing and you're controlling the rate of growth. These are either by market or by demand. Am I making sense with that? Wait, Kasia, did I explain that decently?
Yeah, I mean, yeah, that makes sense for sure. So you can still utilize these other, areas to grow your funds, but maybe just not retirement funds. So again, all three of these can, help, give you a stable financial future, but no double dipping.
No double dipping needed here, not if you do it correctly. So you will want them, but you don't put them here. So something that was interesting, and we've talked a little bit about this before, Kasia, was about using your IRA to hold your precious metals. Now, I love my physicals. I love having my gold, my silver actually in coin form myself. But there are other ways of doing it in your retirement account. Let me give you guys a quick example. I'm going to turn it back over to Kasia. A year ago, I bought my gold and my silver. I bought my gold for roughly $14.90 an ounce, I think. And then as of this morning, it was up to $1,947.40. So if we were to look at that, 1947 divided by the $14.90 I bought it for, means I made 131% on my money in a year. So I made my money back plus 31%. Not a bad investment for holding physicals, really. So how do you do it through a retirement account, Kasia?
Sure. So again, precious metals is allows you to diversify, your portfolio. So you have real estate, you maybe do a couple loans, and then get a little bit of that precious metal in there. So you would work with a company that, provides this investment. They're the investment provider. And typically, it's as easy as going on their website and picking out what sort of precious metals your IRA will purchase. So again, kind of going back to that self-dealing, no physical work. If your IRA is involved, if you're using retirement funds, you would not hold the physical gold yourself. But again, typically you would just store it at a facility like Brinks. And, we help with all that. So we'll make sure that, the gold or silver is stored somewhere legit. But again, same thing, your IRA would send funds to this investment provider, and then your IRA owns these precious metals.
And that's how you do it.
But again,
sorry, I wasn't sure which video it's on. Yeah, it's like, what? So there are so many different things you can do. Once you start learning about investing, it becomes kind of addictive. So if I literally did that purchase of, like literally a year ago, I bought my coins, and I'm holding them because that's where I am in my portfolio at the time, right now. It's not gonna be forever, but it's where I am right now. And when I look at it, I found, I did a 36% return. I don't have a lot of it, but it was a nice return. I wasn't getting that in my Vanguard account. I wasn't. I was averaging 8%. So awesome, great, whatever. But now there are other vehicles out there that I can utilize. So that's why we're saying, like, if you have money that you have in a retirement account, you should seriously consider putting them over into a self-directed IRA. And there are a couple of our people who joined a little late, Kasia, who are military, Josh, Jessica, and Mr. Fred Dumar, Colonel Fred Dumar, rather. So we were talking a little bit about how to use your TSP and how to take advantage of it now with a self-directed IRA. So Fred, Kasia, would you mind having a dialogue on what you think servicemen and women should know and how they go from taking it from their TSP and putting it into something they can control through a self-directed?
Fred?
Okay, I'm on it. All right. Hey, yeah, so if they're retired, then their TSP sort of stops, right? I mean, it's there. It's obviously their money and continues to grow, but their ability to continue to add money to it stops when you retire.
Which is interesting because what most people don't realize is that you can retire very early from the service.
Yeah, typically, obviously some people anywhere from 20 to 30 years, and I'll address the new crowd sort of in a minute, but yeah, previously it was either 20 to 30 years. varying degrees of retirement pay coming from that. But if they did use the TSP and have some money in there, you can roll that over. In fact, as Kasia knows, I used my conventional IRA, combined it with the money I had in a TSP and from a 401k from a civilian job, and put all those monies in the same account. So if you're in the same situation as me, I retired from the Army, worked a civilian job with a 401k for a while, and then also wanted the TSP. And when I met the IRA Club, moved all that money together into one pot together. So certainly simplified my life from a standpoint of dealing with an IRA, a TSP, and a 401k, and allowed me to put all that money into rental homes, which saw a greater return than I'd been seeing in any of those other accounts. Now, young service members now, they have a different option, because when they enlist, they come in with a TSP. And depending on which service they're in, Army, Navy, Air Force, Marines, there's a match set up. So if you talk to any young service members, you should absolutely tell them they're automatically enrolled at a 1% of their base pay, but they will match up to 5%. So again, it's like you're lighting money on fire if you're not maximizing that 5%. And then once you get out, if you want to do something else with that TSP, certainly to roll it into an IRA is a good option. So I'll throw it back to Kasia at that point. That's what I know about TSPs.
Right. And so as we mentioned earlier, and now with the CARES Act, again, the CARES Act is allowing folks to take out a distribution and do a rollover. But what Fred mentioned is, we definitely want to, make it as simple as possible. So rolling over the accounts into one account really makes it really simple, to kind of keep track and have control of that account. And again, if you are able to contribute more to your 401k and contribute more into your TSP, that's kind of foundational to be able to grow that, especially if your company matches. So, continue to contribute to your 401k with work, continue to contribute to your TSP, make sure you're doing the highest match possible. And then when you're ready to self-direct your accounts, or move over just portions of them, go ahead and do that so you can diversify your portfolio and start growing it, much quicker than, as we mentioned, some of these other companies. The problem is the fees. Again, the TSP isn't too bad, but you have folks like Vanguard, Schwab, Fidelity, John Hancock, Merrill Lynch. I mean, the list goes on, and they're just really sneaky with their fees. So they're not going to tell you exactly how much they charge you. You see the commercials nowadays where it's zero commission fees, but I mean we say the fees are like termites. They're small and they kind of eat away at your account every day. So they're not going to send you an invoice and say, hey, we charged you 4 or 5% this year, whether you had a good year or a bad year. They're not disclosing those fees. So that's the reason why we see these accounts just not really grow over time. So that's where self-directing comes into play, because as Jacob mentioned, no one really cares about your funds except you. And so you have to take control. You have to do your research and meet people and create relationships and take control of your finances.
So something a lot of people don't realize was that retirement accounts are a fairly new thing. So when people fight against, self-directed is wrong or about, it's absolutely not. It was actually written to be accessible to everyone. But the problem is a lot of people who don't understand it, well, it's because they're working before 1970, was it
74, yeah.
So before then, most people were working for a company for long decades, blah, 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 and they had pensions. Companies would say, work for us for life, we'll take care of you when you're done in retirement, we're gonna pay and take care of you. And that was all fine when people were living 5 years after their retirement, but then they started living longer. medicine started getting better, health started improving, and we just started becoming a drain on those companies. And those companies are going, oh, whoa, 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 we have too many old people out here that aren't bringing money back into our company, they're taking it away from us, and we're going to go bankrupt until we do something. So the government passed something called the ERISA Act, E-R-I-S-A. The ERISA Act really made every single American alive at that point in time an investor, without ever giving them any education or telling them what was going on. What happened the next day after the ERISA Act was passed were business owners would go to their employees and say, congratulations, we now have a vehicle for you to be in control of your retirement. So it's up to you to save and to work and squander away as much as you can, hold them back, and we are now going to let you save as well as put money into this account that you can't touch until you're damn near dead. So put it all here into this 401k, and we're going to make sure that we match you 3%. Some places are doing 7%. They weren't doing it back then. But they're like, we will give you money to invest in this so that we are off the hook of it. Mm-hmm. Ooh, right. Think of that. It costs them less money to give you a match than for them to take care of you through a pension. Which is why if you have a pension, keep it. But do not count on it being there. Never count on it being there. Do not count on Social Security. Do not count on pensions. Take control, be accountable of your own financial future. My sidebar. So that's what the ERISA Act did. It made every American an investor without any education. So now they were just blindly going to what their employer told them to do. They went to the HR department, the HR office, signed paperwork saying, yes, I will contribute money into Vanguard, because I've already said that once, and you're going to handle it for me. And I don't even know what I just signed, but it sounds really good. And they never looked at it again. They just know that every quarter they get a statement from their broker saying that you've made so much this month or you've made so much this quarter, and that's all they know, and that's what they think they have. So when they get closer to retirement, they're like, oh, that's not enough for me to live on. They just save even more, and they're even more there, which means they're living off less and less and less, which is why their quality of life starts going down. So what they're able to do, going out with friends, restaurants, it all becomes very little. And that's why you now hear our poor elderly citizens going, I'm on a fixed budget. So it's tragic. It really is. Is it better than nothing? Well, if you're not going to learn about anything else, yes, it is. But if you actually want to do what the ERISA Act intended to do, which is to make everyone in charge of their own retirement, they need to have better products for it. Okay, and that's what things like the self-directed IRAs do. That's what some solo 401ks do. There's what some QRPs do if you have your own business, and you can have multiple of them, but you have to know how they all fit together and how you're going to control it. Okay, so this is definitely, this is a tool in your toolbox. For those of you who are new to investing, learn about these things because you're able to teach other people who need it, and you're giving them the opportunity to take control of their financial future and learn something different. Like, for those of you who don't know, my ex was a financial planner for high net worth individuals. And just because he could manage other people's money didn't mean he could control ours. And because of that, fast forward, 15-ish months, I am growing and he did not. Even though he was a financial planner, he was unable to get out of the situation he was in because he did not want to listen to smarter people who were doing better things, even though he was managing their money. So neither here nor there, just wanted you to know that. So what are some of the, if they want to do Kasia, I wanted to ask you about stocks and self-directed IRAs.
Oh yeah.
So
Sure. Yeah, absolutely. So again, we're always talking about diversification. So the stock, you can absolutely invest in stocks and bonds and mutual funds. What you would do is you have two routes to go. You could either set up two accounts. One would be with IRA Club that you would use for alternative investing. So again, as we mentioned, real estate, promissory notes, lending, mobile homes. And then you would set up another account. And typically what I would suggest is to do something like E-Trade or TD Ameritrade, where you could then do your trading yourself. So you could set up a again, either Roth or traditional or SEP. Again, the type doesn't matter, but you would set up a self-directed IRA with IRA Club, which is a true self-directed IRA. And then you would use this other account, again, at somewhere like E-Trade to do the trading. So what's great is the funds can go back and forth between the companies. So if you have, in that example that we did earlier, and, Jacob is paying Bo back, and now Bo's account has, $12,000 in there, then he could use some of that money and move it over to his E-Trade account and buy some stocks, and vice versa. If he bought some Beyond Meat stock last year and then it went up, and then he has all this money, and then he wants to do real estate, then he would simply move the money from the E-Trade account to the IRA Club account. So the transfer is not taxable. There is no penalty. We have a lot of clients that when they first have to move money from these companies, they get a little, apprehensive, and they say, well, I'm gonna have to pay taxes, or there's a penalty. It's not, because the money isn't going to you. The money is just moving from one company to the next. It's called a trustee to trustee transfer. So there is no tax, no penalty, and you can do this as much as you'd like.
That's interesting. I never thought about that. I love learning this stuff. I love it.
Yeah.
Let's see. Bye, Fred. I gotta call you. We gotta talk about the stuff. So I gotta call you. Leanne, here we go. Leanne says, could someone please explain QBP versus self-directed IRA? I think Anderson prefers QBPs and not
QRP.
Sure.
Okay, sure. QRPs. So great. That's a great question. So a QRP stands for a qualified retirement plan. So it's a term that just IRA would anything, IRA, solo 401k, a qualified retirement plan. So we have qualified dollars and non-qualified dollars. Qualified dollars are retirement dollars. So a solo 401k, which IRA Club also offers, as you mentioned earlier, Jacob, are for small business owners. What's great about the solo 401k, it will allow you to be able to take out a loan out of the 401k, again, because the IRA doesn't allow for loans. So if you needed to take out a chunk of money out of your plan, out of that solo 401k, you're able to do that. But they are both essentially the same, whether you have an IRA or a solo 401k. The things that you can invest in are the same. The contribution limits are the same. So you can contribute $57,000 into your solo 401k, and then you can also contribute $57,000 into a SEP IRA. But again, both the SEP IRA and the solo 401k are designed for folks that have a business that's generating income. If your business is not generating income, then you're not able to put in your contribution. So that is what a QRP is. The QRP, whether it's a solo 401k or an IRA, again, the rules are going to be the same. The IRS rules are essentially the same. It's just the solo 401k, depending if you have checkbook control or not, it might give you a little bit more control, and again, allows you to take out a loan up to $50,000. And again, it could be now $100,000 with the CARES Act.
So let's go over that real quick. So this might actually make a little bit more sense, because I'm a visual person, and I had to draw when I was taking my Anderson course to make sure I knew what was going on. So Vault 1, Vault 2. So over here you've got a self-directed IRA. There's also self-directed Roth IRAs. There are solo 401ks and things like that. These are for people who have their own businesses. So 401k, so this is solo 401k. So these are for entrepreneurs, and in fact, correct me if I'm wrong, Kasia, but you can also be a married couple in the same solution.
Yes, exactly. Correct? Yes. Yep.
So, but married, like you can't be like business partners. You have to be married. Am I correct?
No, you could be business partners. There could be two individuals in the umbrella of that solo 401k.
But it's only, I think, doesn't it max out at 2?
I think so. Yes.
Okay. So yeah, see, I feel smart right now. So over here, you have your self-directed IRA and your solo 401k. You can put your business, and then there's you, okay? I'll put us here. Yay! Now, an individual can contribute how much to a retirement account every year?
So again, depending on the type, it's either going to be $6,000 or $7,000 if they are 50 or older. And again, if they have a SEP IRA, the maximum would be $57,000. And that's based on the earnings of the business.
57,000 if they were over 50 years of age, correct?
Yep. Yes.
Okay. So these are the three different tiers. Now let's just go ahead and keep it simple. So if you're over 50, you can put $7,000 annual contribution. A SEP IRA is a different vehicle. You can put the $57,000 a year into that. We'll get to that in a minute. Now, how much can you put into a solo 401k?
So the solo 401k has two buckets. There is the employer bucket and the employee bucket. And the employee bucket allows you to put in, I believe it just went up about $19,500 a year. So as the employer, you would just put in the rest. But again, you cannot go over the limit of 57. So the solo 401k is nice because depending on how your business is doing, there's some years where maybe you don't want to contribute from the employer bucket. Maybe some years you do because those employer contributions are deductible. So again, you'd work with your CPA to really, figure out the right amount of the contribution.
Yeah, it's all the formula. There are different cards you're playing at different times. So you're playing poker, right? So so the boss can put in $19,500 a year, and the employee can put in, it's the same thing, right? It's 6,000, 7,000, right?
So it'd be the remainder. So sorry, I can't do math again. 50, but yeah, the 57 minus 20. So the rest would come from the employer.
37,000.
37,000 would come from the employer.
Roughly, yeah.
Oh, so the boss can do 37,000 and 19,500 is for the employee.
Yes, exactly. Yeah. Yep. Sorry. Yep.
My mistake.
Yep.
19,500 is
for the employee.
And then the boss can do 37.
And then the rest from the boss.
So this is the cool part. When you run your own business, who's the boss?
Me.
Ah, you. Can you be an employee of your own company? Yes or no?
Yes.
Which gives you a maximum of what? Okay. This is getting cooler and cooler the more I do it. So like you want to make sure you're doing this all correct with your CPA or your attorney. You don't want to, I'm not an attorney, I'm not a CPA, I'm an investor who happens to know really smart people who are better looking than me, like Kasia. So you want to know that this is where you can go with it. You want to use your buckets accordingly. Now, this is how much you can put away. But guess what? If you make more than that, can you start more businesses? You tell me. How many real estate investors also have property management companies? How many real estate investors are also licensed real estate agents and professionals? Right? So you can have multiple income streams. You just got to do this all legally and with your CPA and your attorney. Get some who specialize in real estate investing and in investors, because the tax codes are huge, guys. It would be a full-time job just to watch them or read the tax code. It's so thick, right? And then they're always doing addendums. So I heard a statistic once, I don't know if it's true or not, but it would take 40 years just to read the addendums to the tax code. So I want you to understand as you're doing it that it's a lot, and not one person knows everything. You've got some really smart people who might know 10% of it. That's great. Use them. That's all you need right now. Don't make it complicated. But anyway, this is the idea. You're able to put things in. Now, these are your qualified retirement plans. Solo 401ks allow you to do more of this vault, which is, if that helps you understand a little bit more, Leanne. Self-directed IRAs are another one of, they're just another way of doing it. So just start understanding those things. Another vault would be life insurance. Another vault is, gold and silver, commodities, stocks. They're just different vaults that are going to grow your wealth as you go. So when you're talking to your financial professionals, if you decide just to be completely out of it, Let your financial planner take care of it, that's fine. Make sure they're licensed. Ask them if they're fee-based or commission-based. There's been a shift in that industry lately, so you want to make sure you know what you're doing, because they're making money somehow, right? They're making money off of you not taking advantage of it. So you want to make sure you know what you're doing there. But having these vaults is very cool. I personally love working with financial planners because I help them I help their clients get more money under assets under management for their financial planner to manage. So there's a way to leverage it so that, oh, they're going to make a quick 15% with me in this investment, and they're going to turn it back in, and then the financial planner gets more assets under management that they can run. So it's a very good relationship. One of the people on your power team should be a qualified financial planner, a fiduciary CFP. Those are very, very important. Is there anything I should be adding to this, Kasia?
No, and again, you can have, what we say at IRA Club is to start with the simpler plan. The IRA is going to be, again, it's for the individual. IRA is individual retirement account. So you are able to contribute. The fees are going to be lower. The amount of paperwork that's involved is going to be a little bit easier for you to handle. And then once you're ready, maybe in a year or two, you can absolutely do the solo 401k once your business is up and running. But both are available, and we can, here at IRA Club, we can kind of graduate the plan. So you can start with the IRA, do a couple deals, make your contribution, and then whenever you're ready to change that into the solo 401k, we can absolutely do that for you.
That's fantastic. So if they wanted to go ahead and reach out to you guys, by the way, we actually have, is it under our resources tab? And we have a link directly to Kasia and on our investor party website under resources. So there are affiliates, right? So you go there and you click, and we send directly to IRA Club, and they actually will be waiving your setup fee for being a member of Investor Party. If you're not a member of Investor Party, go to investorparty.com. We'll go ahead and prove you, and you can go in and use those resources with those promo codes. Otherwise, you can go ahead and Kasia will get you all set up, but you will have to pay the setup fee, which is very minimal anyway, but whatever. Kasia, what are the, oh, this is the best part. So all those hidden fees that you have through traditional brokerages, custodian houses, they're so hidden. There's so much there.
Yep.
What are you seeing? What are some of the fees people don't look for that they need to know?
Oh gosh, I mean, we are kind of, yeah, it's a lot of, it's kind of the fees for essentially, operating that business. So it's that bill, it's every administrative fee. So like anytime, they mail you a statement and it's the kickback fees. So they have different names. They're coded differently. Again, no one's going to send you an invoice and say, this is how much, you're paying us. The fees are divided essentially per day. So they're just really small, but collectively they again add up to about 4% of your funds. So yeah, it's again very small, and since they have strong lobbyists, they're legally not obligated to let you know what the fees are.
And then you try to call them, and then it's always a lot of fun. But with you guys, you're very transparent. Kasia,
Sure.
What is self-directed IRA with your
Absolutely. Sure. So again, we have low, straightforward pricing. It's $175 to set up the account, and that is your annual membership. So every year we charge you $175 to have the account with us. Once your IRA starts investing, so if you're going to be doing a promissory note or you're going to be purchasing real estate, we charge you an asset fee. And again, depending on the type of asset, it's either going to be $125 or $165, for your IRA to hold that asset. And so on average, you're looking at about maybe $350 a year to have one asset within the IRA. And that's about 90% less than having a like amount within your IRA. I recently did a little quick case study on one of our clients. He purchased real estate in 2018, 3 homes. within his IRA. And then I ran all of the IRA Club fees, you know, again, annual membership, the fee for the house, and then a couple check fees going back and forth for maintenance. And when I, you know, did the percentage of, you know, the 300K that he originally transferred over, it was, the fees were like 0.05. You know, it was like a couple $100, you know, like a grand a year on the 300K. So, I mean, and I did it. I'm like, I want to look at all the, you know, the last 2.5 years, I looked at every fee, you know, all the, you know, the interactions, and it was like, again, 0.05% of his total bucket. So again, very, very straightforward, low fees.
So we're going to get them in touch with you, Kasia, because I love working with her, in case you can't tell. We had you on, I think, 2 or 3 weeks ago. And we're going to have you back on again, because I want you to understand some of the nuances, because they keep changing things with PPP and EIDL and stuff like that. And I just want to make sure everybody stays on top of that. But again, for those of you who are just trying to get started in real estate, or you're starting to get in investing, having this knowledge is incredibly invaluable. Get used to saying it. Reach out to Kasia, start asking questions, watch. They've got an incredible video library of things you can learn. But once you start saying what's going on, and you can start seeing what it is, people will start thinking that, well, you have money even if you don't, but you're going to. So learn how to help people out, and that's what's going to make the bigger difference for really everyone. Don't forget, investing is a team sport. And Kasia's on my team. I'm so lucky. So thank you so much for being here, Kasia. We're so glad to have you. Are you doing anything special, like any other webinars or anything coming up?
We are in the process of setting up an events page on our website. So that should be live next week. So yes, so webinars, hopefully live events soon, social distance live events. But, you know, just check out our website, iraclub.org, and we'll have upcoming events and webinars on there.
Perfect. And we're also going to have them here joining us for our thing. I'm going to try to get a panel going on so we can have people like that you guys have seen on the show. Jose, Shaman, Kasia, Aaron Adams, whoever, just to get them and have like different panels so you guys can see how it all starts to fit together. And that's going to be on Investor Party. So again, if you have not liked us on Facebook, we have a page and a group. Go ahead and find us on Investor Party. Go ahead and join us at investorparty.com or community.investorparty.com. Go ahead and like our nonprofit, which is the Sherlock Holmes Foundation, Sherlock Holmes, H-O-M-E-S, .com. Sorry, sherlocksholmes.org, sherlocksholmesfoundation.org. Good God, could I butcher that any more than I did? sherlocksholmesfoundation.org, and see what we're doing with our kids. And so just for those of you who don't know, Kasia, I haven't even told you. You ready? This is the cool part. So last Wednesday, we closed on our first property for the nonprofit. Okay, so the kids are learning how to flip. They're going to do this condo. They're going to flip this condo. They're going to learn how to demo and build and lay down floors and slave labor. So they're doing all that stuff to learn a skill so they can actually get out of poverty and on to better things in their life. My investor who gave us the funds to do this used his IRA Club retirement account. Yep, and we did the promise
That's awesome.
for you guys, and it's been awesome.
That's awesome.
I love what we're able to do together with the right team. And he found out about it because I introduced you guys to him. So again, guys, you don't need to have money to do this. You just need to know how to find it and grow it responsibly with someone else. It's a team sport. So guys, thank you for being here. I love you. We will see you Wednesday, Tuesday, tomorrow night for Real Estate Survivor, if you're a part of that. If you've not signed up for Stock Market Survivor, go ahead and go to stockmarketsurvivor.com. We can go ahead and get that registered. We're taking that again to the end of the week. We have, right now we have 6 people that are doing it. Yay, we're capping it at 10. So come on, learn how to trade. Emily's gonna be teaching that, and I'm gonna be making games with it, which is gonna be a lot of fun. So you guys are amazing, and we will see you soon. Kasia, thank you so much.
Thank you, guys. Talk to you soon. Bye.
Stay safe out there.